2022 has presented a giant opportunity for many people to scoop up stocks while they're low. While this is awesome, not all stocks are created equally. Some stocks will recover a lot more than others, so that's why we have today's video. Basically, I'm going to show you the very useful tools and methods I use to help me figure out which stocks have the highest percent chance of rising the most in the future, because not all stocks are created equally. Some stocks will recover a lot more than others, given everything we have going on in the economy and the world. So let's get right into today's video. So the first thing I want to talk about is how the market works overall. The stock market is extremely cyclical, and there's just cycles that are always repeating. Some of these cycles last a couple minutes, some of these cycles last months, some of these cycles last decades, right? There are many different cycles within the stock market overall in many different time frames. And there are also cycles in terms of which stocks outperform other stocks. So for example, if we go back on the charts, there was a time period where basically electric vehicle stocks and anything to do with electric vehicles or lithium batteries or anything like that, and solar companies were just outperforming every other industry. Of course, everyone knows of the dot-com bubble, where basically all tech stocks were just way overvalued and they were just flying up quicker than anything else. And there's just endless examples of certain time periods where certain industries do a lot better than others. If we look at the heat map from this year, it's pretty obvious to see which stocks are leading the way. It's definitely not tech stocks, it's definitely not financial stocks, but it is definitely the oil stocks. Like we could see ExxonMobil, Chevron, companies like that are just flying up in a time where almost every other stock in the market is tanking down. So you can clearly see how the stock market has periods where some industries do a lot better than others. And understanding this will be key to implementing the strategy, or at least one of them, that we're going to be talking about today. So basically what you can do is you can go to a website like tradingview.com or FinViz or anything like that. The main thing you want to see is individual stocks, but also broken down by industry or sector, and you just want to get a good gauge of how those stocks or that industry or sector is performing. So right now I'm looking at the S&P 500 index overall and everything within that, and I have it broken down by year to date. So I'm seeing the performance year to date for each segment, you can say. By just glossing over it just very briefly, we can see that there are a couple key things that stand out. We have companies like Meta down 65% year to date, Tesla down 50% year to date, Amazon down 43% year to date. Those are giant notable moves, right? Like even like Netflix down almost 50% year to date. And on the other side of things, we have companies like ExxonMobil up 80% year to date. We have Chevron up 54% year to date. We have MRK up 42% year to date. Now the thing is, these cycles will not last forever. So for example, we will not always see ExxonMobil extremely outperforming companies like Apple. You know what I mean? Like this only lasts for so long, and that's where one of the key opportunities comes into play. What you can do, especially in this market, but really any market going forward, is if you look and see which industries and sectors are down the most, if you can get them in periods where they are severely struggling, most of those stocks tend to do a lot better going forward. For example, let's say the stock market and the economy just booms up going forward, and it's just very awesome, and the economy is rocking and rolling, and times are good, and it's all sunshine and rainbows. Which companies do you think will do better, right? Do you think a company like ExxonMobil, which is up 80% already, will pop more than a company like, let's say, Meta that's down 65%, or Amazon that's down 43%? The stocks that are oversold will have a much easier time rising when the market eventually does calm down. So if you end up scooping up the companies that are oversold or are down the most, it's just a lot easier for them to recover rather than stocks that are already flying high and stocks that people have already been buying. Sure, some of those companies that are already up a ton, they can move up more, but it'll be a lot harder for them to truly have a nice move up. Now, one very important thing to keep in mind is you cannot just buy any company just because the stock is down a shit ton this year. Like, you have to make sure that the company you're buying is actually a quality company. You know, if you just pick out the worst performing stock in the S&P 500 and buy that thinking that it's going to be awesome next year, that's a giant mistake. And the reason is, like, if you have a company that's doing worse than every other company in the S&P 500, there's probably a reason for it. If that company's set to go out of business, or if like something is really bad about the company just fundamentally, then you have to keep that in mind and probably avoid that. So what I do not recommend is don't just buy the stocks that are down the most in the S&P 500. You have to make sure that you're also getting some quality with it. So for example, like, you know, we could see like Amazon down 43%. It would be a lot better to buy Amazon down 43% rather than some company you've never heard of in the S&P 500 that's down 70% or something crazy like that. Like, you have to be strategic in how you do it. So definitely keep that in mind. So basically what I like to do, go to TradingView, go to FinViz. It would be like the FinViz Groups tab, and just figure out and get a good gauge of where the money's flowing into and where the money's flowing out of. Money has definitely flowed out of big tech this year and has flowed into energy stocks, which, you know, makes sense. What you can also do is, I'm looking at a year-to-date section for it, but also if you wanted to get more of like a more recent gauge of things, you can also change it to like 3 months or 6 months and see how the tide is turning. Because, you know, like, these trends don't last forever and they do change day to day and week by week, of course. Another really important thing that I like to look at is what is called, basically you go to TradingView and you type in S5TH. This basically brings up the percentage of stocks above their 200-day moving average. So this is extremely mean reverting, basically, very cyclical. Basically this data point continuously bounces between 10 and 90. When this data point is at 10, it means only 10% of the stocks in the S&P 500 are above their 200-day moving average, and that has historically been a great signal to buy stocks, right? At the same time, when the data point gets to 90, it shows that 90% of stocks in the S&P 500 are above their 200-day moving average. Basically, if you look at this data point, S5TH on TradingView, you can just check back in like every week, every couple weeks or so, and see just a gauge of how the market overall is doing. And like I said, this data point has been very beneficial in the past with calling out bottoms. Of course, nothing is perfect in calling out bottoms, but it does pretty damn good. So if we look at like the most two recent times where we did see touches of that $10 level, you can say, we can see it is on June 17th of 2022 and September 22nd, right? So if we go to the S&P 500, June 17th and September 22nd, right? So June 17th, I will just circle that right here. June 17th, perfect bottom for the most part, and the other one was September 27th, I believe. Yeah, again, like basically perfect bottom. So what you can do is just check back in that indicator every now and then to get a good gauge of where the market stands, and just it's important to reference that because it basically shows you how the market overall is doing. Of course, you can look at the S&P 500, but sometimes that is skewed because not all stocks have an equal weight in the S&P 500. So for example, Apple has much more of an influence over the S&P 500 than a company like, let's say, Bank of America does. So by looking at S5TH, it can just give you a better gauge of how most stocks are doing, and just it's important to look at. So keep that in mind. Another very important thing that I like to use to find out which stocks might be close to their bottoms is something that I don't hear too many people talk about, and I like it a lot actually. So basically, there are multiple ways to get access to this data. I will just be using TradingView because it's nice and easy. But if you go to like indicators at the top left and you just type in drawdown, there's this one by DaxStop. So there's a bunch of them. You can use whichever one you want, but this one by DaxStop is pretty easy. So you just add it to your chart. Basically what you could see is the drawdown for that company that you're looking at over time. So basically what it shows is the percentage off the high. This is useful and important because like stocks move in completely different ways. Some companies just are, for the most part, slow and steady movers to the upside, while other companies have big drops every now and then. Knowing the worst drop that stock has ever had can be very useful into seeing where future drops might end, if that makes sense. So check this out. So if we look at Amazon for an example, we can see right now Amazon is around 50% off of its high. I can see this because you can see the white line is down by basically minus 50. That shows you it's like 50% off its all-time high. When this white line is closer to zero, it means Amazon is, it's at its all-time high, basically. Now what you can do and how this becomes useful is basically what you can do is you can connect the dots of the biggest drawdowns that whatever stock you're looking at has ever had, and that can be useful for finding bottoms. So for example, if we go to the 1-day chart and let's say we zoom out a little bit, we can see that a lot of times Amazon's drop normally ends to I don't want to say peaks, but normally like ends up being a bottom around minus 30% or so. We could see in 2019 dropped around 30%, 2016 dropped around 30%, 2014 through 2015, 30%, 2012, 30%, 2010, 30%. So that's a good point just to keep in mind that, all right, I know if Amazon ever gets 30% off of its all-time high, it might be a good time to look at buying. But of course, this isn't perfect, you know what I mean? Like any system will have certain flaws and certain false indications. Like we could see this year, 30% was not the bottom, but using this data point can be very useful because it shows you literally like the lowest that stock has ever been from its all-time high, and it's just useful. So also if you go to like Apple or anything else, it's just a very useful tool in the sense of like, if you buy Apple right now and it's at its all-time high, you can look back and say, you know what, in the past, Apple's never dropped more than, let's say, 40% off of its all-time high. So there are a lot of ways to put that into useful potential trades. So what I like to do when we have situations where the stock market is down a ton, especially this year, you might look, or what I like to do is I look at stocks and say, all right, where are they right now compared to their worst drawdowns in history? So like, let's say we look at, let's say we look at Shopify as a random example. We can see Shopify right now has had its worst drawdown in history. Basically, in the past, Shopify has never had a drawdown, or most of the drawdowns ended up peaking around minus 30% or so. We can see that by looking where the white lines have basically kind of like bounced off of in the past. There was one significant drop in 2016. That was notable, but for the most part, Shopify never fell more than 30% off of its all-time high. This year was a different story, obviously. It fell by like over 80%. So that tells us like, all right, this is the biggest drawdown Shopify has ever had in history. Is Shopify worth buying? You don't want to just like buy a stock just because it's having its biggest drawdown ever, because the company can be garbage and you don't want to buy that. You know what I mean? So you want to make sure that the company actually has like quality behind it. So what you can do is you can find out which stocks are at their biggest drawdown in history, or at least close to it. Ask yourself, is this a quality company? Do I see this company growing in the future? And is this company trading at a good valuation? If all of those boxes, check out good, then that company might be worth trading and it might have a solid recovery going forward. At the same time, if you looked at a company like ExxonMobil in this market environment where it's at its all-time high, it's the risk-reward ratio isn't there, and it's not the same with a quality company that is significantly off of its all-time high. So keep in mind, all the features I talked about so far are just helpful guiding tools. Of course, every single system has some flaw to it, so definitely keep that in mind. But what I talked about today is some of the top things I like to do, especially when we have stock market drops. I would say my favorite one is just simply going to a heat map and getting a nice gauge of where the money's flowing and where it's flowing out of. Now, one very, very useful tool and one of my favorite things, especially like when we have big discrepancies in different industries, if that makes sense. So for example, we can see by the heat map right now, we have energy stocks up a ton while we have tech stocks down a ton. What we can do when we see big differences like that is what's called a pairs trade. So basically what you do is you might buy, let's say, a company like, I don't know, just some solid tech stock, like let's say Amazon, for example, or maybe Meta, or maybe you might buy Disney, or just something that's like of good quality but is trading at a low price. And at the same time, you would short a company that might be a little bit overbought, if that makes sense. What you're essentially doing in this scenario is you're betting that one company will outperform the other company. So for example, like let's say you look at Amazon, right? And like let's say you look at ExxonMobil. You might say, you know what? Amazon is down a ton this year. It has all-time highs around like 190, and now it's at 95, right? Amazon, realistically, they're not going out of business anytime soon, and their valuation's decent. So what you might say is like, all right, it's looking pretty good, but what if we see like a horrible recession and the world gets a lot worse and the stock market tanks, right? That's a big risk factor, right? And then you might look at a different company, whether it be ExxonMobil or even a different tech stock, right? You just want to find a different stock that you think is not as good as Amazon, right? You can look at anything, right? You can do it in the same industry. You can do it in many different ways. Like you can do a pairs trade with Amazon and Home Depot. You can do a pairs trade with Amazon and Apple. You can do a pairs trade with Amazon and ExxonMobil if you wanted to. But you basically want to find one undervalued stock and one overvalued stock. Let's say we look at ExxonMobil. You might say, you know what, oil prices are high. They probably won't go down too much in the future, but I still think ExxonMobil is a little bit overhyped and it's overvalued. So in this scenario, you might say, I'm going to short ExxonMobil and I'm going to long Amazon. Essentially, all you're doing is betting that Amazon will outperform ExxonMobil, and that way, whether both stocks rise, both stocks fall, or both stocks do nothing, you have the opportunity to win as long as Amazon pops up by more than ExxonMobil in this scenario. So I don't mean to complicate this too much, guys, but the main thing is you want to find one stock that's undervalued, one stock that you think is overvalued, buy the undervalued one, short the overvalued one, and whether the stock market goes up, down, or sideways, you have the opportunity to win as long as the stock you are buying pops up by more than the stock you are selling. So keep that in mind. This is called a pairs trade. Some people also refer to it as a long-short trade. It's very popular with hedge funds and institutional traders, so keep that in mind. I also do really like it, so keep that in mind as well. I hope you guys learned something from this video. Basically, whenever we see crazy events in the stock market, there's a lot of opportunity associated with that in many different ways. So I hope this video is able to help guide you as to which stocks have the most profit potential going forward. There's a lot of different methods you can use, so keep that in mind. Also, I want to say, check out this video on the screen right now. It goes very well with what I just discussed in today's video, and it shows you some very key things that will end up saving you a lot of money trading over the long term, and it'll save you a lot of stress as well. Definitely check it out, and thanks for watching.